All right, I'm going to make up an introduction for Scott. Scott Bolger is the Area Executive Vice President on the aviation side for Arthur J. Gallagher Risk Management. How am I doing? Okay so far?
Fine so far.
He is a commercially rated multi-engine flight instructor.
Yep.
Also has an A&P.
Yep.
And built and tested his own experimental airplane.
So I'm crazy.
So he's crazy, and I'm wondering if he actually managed to, had any problem insuring that airplane.
I actually didn't have a problem, believe it or not.
So Scott, thank you for coming.
No problem. Thank you all for having me. Hopefully we'll have fun other than the boring insurance speak, because please ask questions of me during this thing. If you've got questions, throw it out there. Insurance can be fun if you make it fun. So we'll try to do that. Real quick plug on just Gallagher as a whole. Arthur J. Gallagher is the 4th largest insurance broker in the world. We've got 19,000 plus employees, $3 billion in revenue. We are one of the only brokers that have ever been voted the most ethical company by Ethisphere. No other broker has been rated that. So we're very proud of that fact. We have offices around the world, many offices throughout the United States. Aviation insurers. What are they? Who are they? There are a lot of them out there, and they've expanded in the last 5 to 7 years. Prior to 2003, right around 2003, 2002, if you wanted to buy a $100 million liability limit, you had 3 choices: AIG, USAIG, or Global Aerospace. Those were your choices. Now all of these insurers can offer you a liability limit above $100 million. So you're up to about 12. Now, while they're all aviation insurers and they all issue aircraft hull and liability or airport liability policies, every single one of those policies is different. And I don't care if you're with the same insurer. You might have one USAIG insured versus another USAIG insured, and the policies are completely different, operating the same aircraft out of the same airport. So they're absolutely different. So when you look at insurers, you have to be very specific about what you're looking at. They're all different. There's no right or wrong answer on any one of them. They're all good. They're just different. A really important thing, we talk about teaming. Teaming is a very important thing to deal with in aviation insurance. There's 3 partners on an aviation insurance policy. There's the client, you, the broker, me and or whoever broker you're using, and then your insurer. Now, normally, most people, how they interact with this is they interact with their client broker, and that's the only interaction they have unless they have a claim, and then they talk to their insurer. You really don't want that relationship. You really want to be talking to your insurer personally and directly. If you're not having meetings with your underwriter at least once a year or once every other year because you're really busy, you're doing yourself a disservice. You really are. I'm the hammer. As a broker, I'm your hammer. You're the nice guy. The underwriter really wants to meet with you, and the underwriter really wants to tell you yes. The underwriter wants to tell me no. So we work on your behalf as a broker. You really need to have that 3-legged relationship because it will affect what gets done on your policy, how things get done on your policy. Operational control. We were just talking about operational control. I have a Part 91 operator that has 3 interchange agreements. All those interchange agreements have been filed with the FAA. They've all been acknowledged with the FAA. They've all been filed with the insurer. Everyone's cool with it. There's another 135 operator who's not very cool with it, and they've reported them to the FAA. Ultimately, the FAA went to the client, to their attorney, their regulatory attorney, and to their insurance company asking them, what's going on here? And everyone was on board as to what was going on, so it went away. It was done properly contractually. It was done properly on the insurance side. And that comes from having a relationship with the underwriter. So it's really key to do that. Understanding your broker-insurer relationship. I'm a broker. What do I do? And you have an insurer. What do they do? Your insurer is a financial transaction. Your insurer is not going to fix your airplane. Your insurer is not going to do things for you. They're not going to be responsible for the operation of your aircraft. They are a financial guarantee. They're going to pay for certain things that you've agreed on in the insurance policy. That's a key thing to remember. They also have emergency response expertise. They deal with claims and accidents every single day. You probably don't. So they're a good expert to talk to say, hey, look, if I have an expert, how do I deal with this? They do it day in, day out, every day. They can do loss control for you. You have a hangar facility out there, and from my personal experience, ultimately you can walk through your own hangar 100 times and not see something that's wrong. Yet somebody can walk in and just look at something going, why are you doing that? This is what they're there for. They can come out and they can look around and say, hey, have you thought about this, or have you thought about that? Don't view it as an adversarial relationship. They're just there to help you. Most insurers, they're not going to jack up your premium because you're doing something that's crazy in your hangar. They're just going to say, hey, have you thought about this? Have you thought about that? They're just there to help you. So just remember that when you talk with them. Contractual liability expertise. I'm going to get to this later. Contractual liability, you've heard about it already from the prior people. It is a huge exposure in aviation that is often overlooked. And I'll get into it later, but it's something you really need to pay attention to. Your broker. What does your broker do for you? I've already said I'm kind of the hammer. I'm your negotiator. I'm out there for you, working with your insurer or other insurers to negotiate the best price and the best coverages available in the marketplace to you. But I'm also a risk identifier. I work for you. As a broker, I don't work for the insurance company. I work for you. So it's key to have your broker come out and say, if you don't want your underwriter to know anything, talk to your broker. Call them up and say, hey, I'm thinking about doing this, or come and visit my facility and tell me what you see or what you don't see. And it will help you out. I had one client, they're very big on OSHA compliance. They have all kinds of, it's a helicopter operator, they have all kinds of actual safety equipment in their facility. I just so happened to pop by one day, and one of their maintenance guys was doing work on the engine. No safety harness, no ladder. He's just climbing up there and propping himself up there. There's nobody supervising him. He's all by himself. Guys, you really want to be doing that? This guy can fall off and you're going to have a serious problem on your hand. So these things happen. It's just day in and day out work. I understand it's a very risky business that we do. So I'm also a claims consultant. Your broker is there to help you negotiate with your insurer. Your broker knows what your policy says and what it doesn't say. Your broker knows where all the gray areas in your coverage are. They can tell you where to push and where not to push. I have had clients who have said to me, where can I push this? I say where they can push it. They've had attorneys tell them they should push it in another direction. One of those clients that actually had that happen to me, they actually sued their insurer and they lost. We told them not to sue their insurer. It went bad. So you just talk to your broker and say, hey, what do you normally expect of us? What can be covered? What can't be covered? That's what they do day in and day out. Market expertise. We can out there, you're insured with USAIG or Global Aerospace. You've been insured with the same insurer for 25 years. It's a great relationship. But something else is going on. You start getting into drone exposure. You start doing something else. You start getting into a charter relationship. It may be that your insurer, who's been great for 25 years, really isn't that good at this new exposure. So you might need to talk to another insurer. So your broker can tell you within a minute of, hey, this insurer can do this or that insurer can do that. So at any given point in time, if you've got a difficult risk or something that's a challenge, it can be solved. It just maybe have to be solved with another insurer. Benchmarking database. Our aviation insurance market, as you saw, we had 13 different insurers. It used to be 3. All of you, on average, are paying about 1/4 of what you paid 10 years ago. That's on average. That's literally what's going on with the premium rates in the aviation insurance marketplace. Well, how do you know whether you got a good deal? How do you not know whether you've got a good deal? Well, your broker, if you ask them for benchmarking database, they can sit there and say, okay, you have X liability limit, you have X hull coverage, that compares to all these other operators out there, and they can show you where your premiums compare to everybody else. Contractual liability consultant. Mercer probably gets sick of me. I handle Mercer. He sends contracts to me all the time. Contractual liability, again, I'll get into it later, is very onerous. Your broker is there to help you. He's there to tell you what's available, what's not available, what can be done, what can't be done. He's also your confidant. You just call your broker up and say, hey, I want to do this. What are the risk exposures? What do I need to do with this? What am I not thinking of? They'll bounce it off with you. They'll talk it through with you. So don't hesitate to involve your broker, but it's also very important to get your insurer involved. Why do I need to understand that relationship? I typed things happen. I actually had to type to say something else happens, but I didn't go there. Here's the first one that you all might know. That's a Gulfstream. That's the Heinz Gulfstream. It was being towed behind a tow truck, and you can see that there. Tow bar broke. That's what happened. So we both got damage to our aircraft and damage to somebody else's aircraft. Who's liable for what? Next one. We all know Dulles Jet Center. Dulles Jet Center happened. There were 13 aircraft in that. It was a $350 million claim. Hangar collapse. Ironically, there was a Challenger in there that had flown in there and desperately wanted to get into the hangar to get out of the weather. Bad luck. He actually got in the hangar and it didn't work out well for him. It does happen. That's the inside of the Dulles Jet Center hangar. Interestingly enough, we also insure salvage yards. And if you think your airplane's worth much after an accident, it really isn't worth much. One of these Global Expresses over here, ultimately $45 million jet, the salvage went for $5 million. Salvage company sold the 2 engines the very next day for $8 million. That's how quickly this stuff gets and how low the value comes out. This is another interesting one. This is a Hawker 800 that encountered a glider at 18,000 feet over Colorado. Everyone survived. The pilot of the glider actually parachuted out. Everybody on the airplane survived. The captain was pretty severely injured, but he survived. This is stuff that happens every day. You just don't hear about it. This is another good picture. Windstorm claims happen all the time. There's a citation, or what was a citation, no longer in existence. We have another aircraft in the lake here. There's 2 parts to an aircraft policy, an aviation policy. There's first-party claims, i.e. damage to your aircraft. It gets damaged, bird strike, lightning strike, FOD, whatever. Then there's third-party claims. I'm going to start off with first-party claims, the damage to your aircraft. One of the key things that we're dealing with on a day in and day out basis right now is, what do I insure my aircraft for? Do I insure it for Blue Book value? Do I insure it for stipulated loss value? Do I insure it for outstanding value? Do I insure it for replacement cost? Or do I insure it for what I have it depreciated to? Everyone deals with this differently. There is no right or wrong answer. The difference is each one of these will have potential pitfalls and benefits. And I'll give you examples. One Fortune 50 company says, I want to insure my 1997 Citation that's worth $3 million. I want to insure it for $12 million because I'm not going to replace it with old. I'm going to go buy a new aircraft. Okay, that's fine. You can do that. Some insurers won't let you do it, but for the most part, you can do it. But here's the problem. A, you're going to pay premium for $12 million. And B, when the loss happens, the underwriter's going to try to fix that aircraft faster than they're going to pay you $12 million. That's the problem with over-insuring a hull to replacement cost. You're going to have an argument on your hand with your underwriter should that loss happen. You could insure it for Blue Book value or book value. Let's do it for book value. Your premium is really low because you've depreciated the asset out. But if it's the aircraft's a total loss, they're only going to pay you. They're not going to pay you to replace it. They're going to pay you what that value is on that policy. So your premium's low, but when the loss happens, you might have a problem. The other thing that really comes into this, if you have engine leases, a lot of these aircraft, citations, we see it all the time. We might have a citation insured for $2 million. You go out and get a leased engine. The leased engine, the lessor says that engine's worth $1.8 million. Great. So my airplane's a total loss in a hangar fire, and of the $2 million that I got it insured for, I got to pay $1.8 million to the engine owner. You got $200,000 left over to buy a new aircraft. You got to be careful as to how that's insured, what works. More importantly, what's not covered? That's another thing that you need to know and what you need to run across. You all have probably heard wear and tear is not covered. Outright is not covered. Betterment is not covered. What do they mean by betterment? Let's say I have a bird strike, or let's take a FOD, for example. I have an engine run through or a goose run through my engine. I got 50 hours left on my life, on my engine before overhaul. And all the turbine blades are damaged. They're not going to replace them with new turbine blades, and you're not going to get a proration. They are going to prorate those turbine blades. You're only going to get a portion of what that turbine blade's worth. So just understand that's what's going to happen when betterment happens. Diminution of value. We see this one on a regular basis. Diminution of value is your airplane's damaged, you get it fixed, and it's just not worth as much as it used to be because now it has a damage history on it. Some insurers will provide diminution of value coverage, but what I tell my clients is be very careful with it. Usually it's very expensive, the limits are usually low, and you're looking for an argument when the loss happens. That's what's going to happen with your insurer if you buy diminution of value coverage. Third-party jeopardy. I love the tune. Everyone else is using my lines here. I wanted to use jeopardy, so I'm going to put the answer up there. Everyone tell me what's the answer to that $5 million. What should the question be? What's that? How many commas? What's the other one? How much money you have. You want to know what the real answer? The real answer is that's how much you're going to pay an on average one passenger who's killed on your aircraft. That's on average. The worst case scenario I've ever seen was $60 million for one person was paid out. Well, how do I get to that number? Where did that number come from? The chart that really explains it very quickly. When you kill somebody on board your aircraft, it's very simple calculation. They say, how old are you? How much do you earn? I'll give you a 4% raise for the rest of your earning life until the age of 65. Add all those numbers up, and those are the numbers that result. So if we look at a guy at age 35 who earns $250,000, he's going to earn $13.6 million over his lifetime. It's actually cheaper to kill an older, wealthy person than a middle market manager, believe it or not. So if you want to kill someone who's older, doesn't have kids, all right? It's cheaper that way. So that's just to give you an idea of the numbers you're looking at. So when you hear your broker or your underwriter talk to you about buying limits of $100 million or $200 million, it's a straight calculation. You got 8 seats, multiplied by $5 million, that's $40 million claim you're looking at as a minimum. That's not, you haven't even hit anything on the ground at that point. That's just your passengers. So liability limits are very cheap in the insurance market right now. If you want to buy a $500 million liability limit, it's available. It's cheap. $500 million. Back in 2003, a $500 million liability limit went for about $150,000 if you wanted to buy it. Today, it's about $24,000 to buy a $500 million liability limit. It's inexpensive right now. And I don't see it changing anytime soon either. Next 2 or 3 years, it's going to still remain to be cheap. So that's why we talk about liability limits. Always look at them. Liability claims. What's a liability claim? Under your policy, under an insurance policy, what does it pay for? It pays for bodily injury. You injure somebody or kill them. Property damage, you run into something or hit something or damage something. Or personal injury. Personal injury is libel, slander, or false imprisonment. Guy gets drunk on your airplane, you strap him into his seat, he sues you for false imprisonment. It can happen, it does happen, believe it or not. It is covered under the policy. Where do they come from? Aircraft accidents. Number one reason why you're going to get sued. Ground losses. Can't make this up. You get a contract cleaner, comes into your aircraft, he goes up in the aircraft, he comes walking down the airplane stairs, and he slips down the stairs. He sues you. It's a ground loss. Libel, slander, false imprisonment, kind of already talked about that. More importantly, contractual liability. It's another area where, again, it's key, and we'll talk about it again in a minute. Contractual liability. What is contractual liability? Contractual liability is essentially you're assuming the liability of someone else for what they may do on your behalf. You can see it from all types of angles. Insurance is a contract. engine leases, aircraft leases, hangar leases, crew service agreements, FBO agreements, fueling agreements. They come from everywhere. And every one of these contracts, I'll tell you right now, is more than likely one-sided against you, the aircraft operator. Let's take an engine lease for an example. An engine lease, if you read it, it actually says, hey, if anything goes wrong with this engine, even though I maintained it wrong, I manufactured it wrong, or I did something wrong with it, it's your problem. You pay for it. That's what it says. It also says, if we get sued for it, you're going to pay on our behalf. Here's the problem. Your insurance policy is not going to cover that. It outright will specifically exclude manufacturers of engines or aircraft, or someone who's providing service to an aircraft. So you actually have to change the contract. You have to be very careful about how you change the contract. Contracts say all kinds of different things in them. Hangar lease agreements. Perfect hangar lease agreement. You'll see it all the time now in hangar lease agreements. They're going to make you responsible for any environmental damage that you might do at that hangar facility you own or operate or lease. As you all probably know, airports are environmental wastelands. We've been spilling fuel and oil and all kinds of stuff at airports forever. So you've just signed to agree to pay for any environmental damage that exists at that airport. You've got to be careful as to what it says and how it reads. I have one client of mine, he's a ground service provider to the airlines. Leases a warehouse on the O'Hare Airport. The warehouse is right next door to an MRO facility. Can't make this up. Client decides to sign the contract, or if we told him don't sign it, you have to understand what you're taking on. Building owner comes back to him and says, hey, there's oil underneath your property. There's 3 EPA violations that are out there for this building. You need to pay for it. $300,000. And by the way, environmental liability coverage is not covered under your aircraft liability policy, your airport liability policy. It's a very specific insurance coverage. So be careful with that. Contracts will get you every which way but loose. You just got to be careful with them. 2 sections in a contract you need to be careful about. There's an indemnity contract section and there's an insurance section. What's an indemnity section? Indemnity section essentially says you will pay on behalf of the other party. Even if you have insurance or not, you're still paying for it, one way or another. This may or may not be insured. You don't know. It all depends on the circumstance. In many cases, provisions are beyond the scope of insurance. So I'll give you an example. In your indemnity agreement, you've agreed to indemnify your hangar owner or lessor for any and all loss that might result of that engine or hangar. Yet your policy has a nuclear risk exclusion. So someone sets off a dirty bomb, their engine is damaged, or you cause damage to somebody else, you have no insurance coverage under your policy. But you've agreed to pay for it. So you need to be careful on those contracts. The indemnity can get you. Insurance section. The insurance section simply outlines what kind of coverages you have to buy, what limits you have to buy, and whether you need to add certain things onto that policy. So more often than not, take signature flight support. They're going to say aircraft liability, environmental liability, auto liability, workers' compensation, so on and so forth. You may or may not have those insurance coverages. Signature is one of the bad ones. If you deal with the airlines, Delta Airlines is one of the bad ones to deal with. They're very stringent on their contracts. They're very good at their contracts. So do we have the coverages requested? And I will tell you from practical experience that a lot of times these insurance and indemnification provisions are taken from other contracts, cut, paste, put into the new contract, and they have no relevance to what you're doing, or they reference coverages that don't exist, are not possible, you can't obtain. You just need to know that. So do you have the liability limits that they're requiring? Is it fair and equitable? And this goes back to certain people ask for certain coverages that are just not fair. They're not appropriate to you. And I'll give you an example that comes up more often than not. You might get a charter customer that says, I want a breach of warranty. That's what they say to you. I want a breach of warranty. What a breach of warranty does, it's usually issued to a bank, and it says to the bank, essentially, if I put a 12-year-old in the cockpit that doesn't meet my open pilot warranty and my insurance company denies the claim to me, it is obligated to pay the bank for the value of that aircraft. Here's the rub. If they pay out under a breach of warranty claim to your bank, your insurer, can now sue you for what they just paid out. This actually happened in the Learjet crash out in Colorado. They actually paid out a claim out to the bank, and now they're suing their own insured for that. Normally, you're not allowed to sue your own insured. So there's a lot of things that are put into contracts that are not fair, they're not appropriate, and they should be taken out. I want to be included as additional insured. You'll also see it referenced as a named insured. There's big difference between additional insured and named insured. They'll want a waiver of subrogation, which essentially means, hey, if I damage your aircraft, you can't sue me for it. That's what a waiver of subrogation does. Talked about breach of warranty. A severability of interest clause. Severability of interest clause simply says that if we're both insured under the policy, your insurer is obligated to insure us separately, as if we're not together, so we can point fingers at each other. That's what a severability of interest clause does. Primary wording. If they ask you to put primary wording on there, what that means is now if a loss happens and they have insurance and you have insurance, your insurance is paying first, theirs is paying second. You've got to be careful what they're asking you to do and whether it's fair or not. Emergency response drills. As you all get into SMS, you'll all start dealing with emergency response drills. One of the things where I see things go wrong on emergency response drills, and more often than not, they only involve the flight department and certain members of the flight department. They should involve a lot more than just your flight department, especially if you're in a corporation that has other manufacturing operations, because most corporations will actually have an emergency response plan already in place, already tested. It's very good at what they do for their manufacturing plant. They have no idea how to deal with the NTSB at an accident site that happened 1,200 miles away from home. They simply do not know how to deal with it. So you need to have an emergency response drill, not only with the flight department, we need to get the risk management department. They're the ones who arrange the insurance more than likely. We also need to get the legal department, because they're going to want to say, hey, this loss happens, I'm going to defend it. The problem with that is your insurance company is going to say, hey, I'm paying for it, I'm getting your defense cost. So you absolutely, when you get the legal department, why you want them involved is you want to have the conversation with them to say, hey, we have an accident over here and this happens and there's a suit. Are you going to want anybody in particular defending us? Because if that's the case, we need to talk to our insurance company about it and make sure they're on board with that. You need the HR department involved, because you're probably going to have employees on board. You're going to have workers' compensation claims, employee benefit claims. They're going to deal with your employees that are injured or killed. And the finance department. Finance department's going to want to be involved because they're going to pay for a lot of this stuff. And what I usually tell people, if you're going to have an accident, assume you're paying for it. Don't assume the insurance company's paying for it. Act as if it's coming out of your pocket. Do the right thing. How would you want to be treated if you were involved in this accident? Corporate security. Corporate security should get involved with this, because ultimately, most corporate security people are police and firemen, ex-policemen, ex-military, and they have connections around the world. So when you have an accident, the people who are going to control that site are probably police officers. You'll get a lot of information out of your corporate security department as opposed to someone showing up saying, hey, I'd like to get some information about this accident, because police and fire, they all talk amongst each other. So they're important to know that. Your insurer. Your insurer is important to be out at that meeting as well, because ultimately they're probably going to pay for most of the stuff, hopefully all of the stuff, but you never know. The other reason the insurer should be involved with that meeting is they've been through it before. If you have a fuel spill because you had an accident, they probably know all the environmental contractors that can clean it up. If you're going to need an attorney, they know all the attorneys that are out there that they can interact with you. So ultimately, your insurer is important in that meeting. Your broker is involved. I always say you want your broker involved because they're going to help direct you as to what's going to happen during an event. Because when an insurer is there, they're just looking from their financial perspective. They're not looking at it from the HR department or the risk management or the legal department. I've had a number of these response drills done with Fortune 10 companies, and they have all these people involved, and it's almost comical to watch what happens because everyone says they're responsible for it and they're going to take care of it and they're going to do it, when in reality they can't. And the broker's there just to remind you, hey, legal department, you realize you're not going to be able to get to the crash site. You're not a party to the investigation, therefore you're an attorney, you cannot get on that accident site. And the legal department's going to want to force their way onto it and get all the information they can, and they can't legally. So the broker's just there to help guide and suggest. When it comes to emergency response drill, everybody else is more important than the broker. He's just there to help. Really, the closing side of this is, when in doubt, involve your insurer and your broker. The more they know about your business, the better off you're going to be. The better premiums you're going to get, the better coverages you're going to get. Don't be afraid to get them involved because you're afraid they're going to jack up your premiums. That's not the way they operate. They just want to help you and do it properly. Ask questions. Absolutely ask all kinds of questions. There's no such thing as a stupid question. Things come up day in and day out. You might ask about a workers' compensation claim. You might ask about, how does this contract affect me? It could be anything. It could be emergency response. It can be loss control. It can be risk management questions. It could be pilot loss of license questions. They might be able to help you with that. Just be cognizant of the exposures that's going on. From my perspective, many people do a lot of things and they don't realize what they're taking on. Contractual liability being one of them, but they look at it and they say, this will never happen to me. I'm here to tell you it happens every single day. Question, you probably all know this, and not necessarily corporate aircraft. I'm talking all aircraft in the United States. Does anybody know how many happen in an average month? Any guesses? Over 100 every single month. That's how many happen. So it goes on day in and day out. So corporate-wise, the more often than not, fatal corporate accidents are very rare. They're extremely rare. But what happens on the corporate side are bird strikes, lightning strikes, FODs, ground damage, hail claims. That type of stuff is what happens more often than not. Review your insurance policy with your broker and your insurer every year. If not every year, every other year. Literally go line by line. An aviation insurance policy probably has 120 different coverages in it, and every one is different, and every applies to different circumstances in every different case. Review that and go through the line item and say, hey, should I have this? Do I need mechanics tools coverage? Do I need search and rescue coverage? Do I need extra expense? There's 100 different coverages in there that you have to go line by line to make sure they're adequate. Operate as if you'll pay for the loss. I kind of said it once before, but just act as if you're going to pay the loss as opposed to your insurance policy paying the loss. I mean, idealistically, the insurance company should pay, but God only knows what happens. We've alluded to it before. An insurance policy, the bigger the claim gets, the more they're going to try to back out of a claim. They're going to say that you didn't have an approved pilot. You didn't tell them this. You didn't tell them that. That's why, another reason why you meet with your underwriter, your insurer, and tell them everything. They can't claim that they didn't know. You told them. You gave them the information. So just involve them and be cognizant of what you're taking on and just pretend as if it's your money. Any questions? Yep. Well, it's all a factor of the capacity in the marketplace, the number of insurers that are out there. There's a number of other reasons, and I'll drive into them a little bit. First off, you've gone from 3 to 12. So they're all competing for the same amount of business. There's not a huge number of other aviation operators that are entering the business. It's all the same market. So they're all competing for that business. The other factor that's joining it, about 2003, insurers buy what's called reinsurance. It's insurance for insurance companies. If you have an accident, they'll pay $10 million out of their pocket, and then they'll go into another insurer and say, you pay the rest. Prior to 2003 or 4, the reinsurance company said, hey guys, I'll sell you reinsurance, but I'm going to charge you for every aircraft you put on board, I'm going to charge you a minimum premium. Whatever the number is, $5,000, $10,000, whatever. I'm charging you that money. So your insurer is going to take that cost, pass it right back to you, and you're going to pay for it. Well, right around 2003, 2004, a lot of new insurers came into the marketplace. Well, and all those insurers said, well, I shouldn't have to pay you that much because I don't have this legacy exposure and all this other stuff going on, so I shouldn't pay you that. Reinsurers said, okay, you're right. We'll only charge you a percentage of your frontline premium. So now there's no longer a floor of the reinsurance cost. The reinsurer just said, hey, I'll just charge you a percentage of your frontline premium. So now the main insurer can charge you almost anything. And they're only going to pay a percentage of that to their reinsurer. The last contributing fact, aviation underwriters have been changed. After 9/11 happened, all the insurance companies started realizing what exposure they had to aviation. So they started incorporating the aviation insurance market into the property and casualty, and aviation is tiny compared to the property casualty market. We represent like 2 or 3% of the overall worldwide premium out there. So they brought them in to their P&C world, and they convinced them and incentivized them to go out and sell new business. Sell, 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 sell. Go out and sell. Don't care about the profitability. Don't care about whether you make money or not. It's go out and sell. So a lot of these underwriters are just out there. 10 years ago, an underwriter would ask you, have you had any losses in the past? Yes? No? How much were they? They don't even ask anymore. They don't ask whether you have losses, which is ridiculous. Because one person having loss after loss after loss should be paying more than someone who never has a loss. That's not they don't make that differentiation anymore. So that's the other contributing factor, in my opinion. So why do I not think this market's going to change? Why do I not think your premiums are going to go up dramatically? The only way your premiums are going to go up dramatically, you start having a lot of losses. The only other way it's going to change is the reinsurance market changes, or the insurers start incentivizing their underwriters to look at profitability. Because you can't, as an insurance company, I'll pick a Gulfstream. Let's pick a $50 million Gulfstream with a $300 million liability limit. Your insurer is probably charging that Gulfstream somewhere around $40,000, $50,000 on an annual premium for a Gulfstream. You have a bird strike, it's $50,000, it's $100,000. You have a FOD, it's $100,000. If you have a lightning strike, if you have a hail claim, it's going to be millions. You can't afford to charge someone $50,000 and have it on average claims for just bird strikes, lightning strikes of $100,000. You can't afford it. It's not sustainable in the long run. So I kind of couch my clients and say, look, the market's soft, the premiums are not going up, but man, when they do, it's not going to be pretty. Because these underwriters are not making money. I don't know how they're going to make money at this, what they're charging right now. So that's kind of the answer to your question. Any other questions? Yep. Non-owned aircraft liability. What specifically about non-owned aircraft liability? Okay. Non-owned aircraft liability is a huge exposure. It's covered under a corporate aircraft policy or a charter aircraft policy. It's a big exposure that most corporations don't even look at. They don't even think about the exposure they're taking on, yet they're huge exposures. It's a great one of those examples of you don't realize what you're taking on. If an employee pilot goes and flies his own personal airplane on company business and has an accident, the company is going to get sued. That's a non-owned aircraft liability exposure. If you have an employee pilot that he goes out and moonlights to another operator, you want to make darn well sure that he's shown as an employee over there and not as an employee here, because they'll try to make the argument that he's your employee, you trained him, it's your fault. So it opens up a little bit of a Pandora's box. And again, the average claim being $5 million a person is what you're looking at. So non-owned aircraft liability, I'll give you an example of a really bad claim. Sony Records. Sony Records chartered an aircraft. Actually, they worked through a charter broker to be more specific. Called the charter broker, said, hey, you need to use a twin turboprop aircraft to fly our passengers, the singer Aaliyah, down in Bermuda, if you remember this claim at all. They said, hey, we need you to fly Aaliyah from point A to point B and all her posse. King Air wasn't available. Charter broker went out and got a 402 with $1 million liability limit. Then put 7 guys, bodybuilders, along her security guard and her on a 402 with a pilot that had cocaine in his system and was about to get his license revoked by the FAA. Airplane crash kills everybody. Sony Records was sued because there's only $1 million of coverage on the aircraft operator's policy. Essentially went to court. Sony Records said, hey, it's not my fault. I went through a charter broker. They were supposed to do this for me. Went to Sony Records and say, do you have a flight department? Yes, we do. You have minimum pilot requirements? Yes, we do. What are those pilot requirements? We told them what they were. Did you not do this for the non-owned aircraft? No, we didn't. Judgment for the plaintiff. $60 million plus. It happens. It absolutely happens. So non-owned aircraft liability is a very insidious exposure. It comes up all over the place that people don't realize it's going on. So, does that answer your question? All right, so yep. Yep. Correct. Correct. Yep. Let's use Aon Alberto Culver, the Gulfstream crash at Palwaukee, as a perfect example of a non-owned aircraft liability claim. Aon borrows Alberto Culver's Gulfstream 4. We put an Aon captain in the left seat of the Alberto Culver aircraft. We put an Alberto Culver captain in the right-hand seat. Airplane crashes, kills everybody on board. Ultimately, Alberto Culver policy responded on behalf of Alberto Culver, but Alberto Culver's insurer said to Aon, you are not covered. You operate a flying service, you should have your own coverage. Therefore, you're not covered. If you look at the policy, all policies say that, by the way. All of them do. So Aon had non-owned aircraft liability coverage to cover the loss. And that's another issue to be example. There's liability, people you kill, and then there's also liability to the aircraft itself, the $28 million aircraft that we totaled. So it's very insidious how it comes up and how it plays. And that also, when you talk about non-owned aircraft liability, all aircraft policies, if you hire a contract pilot, contract pilots are not insured on your policy. You're insured, but the contract pilot's on his own. He's a full-time flying person. He should out and have his own insurance is the way they look at it. He's strictly excluded under every aviation insurance policy. If you're a contract pilot, you should be asking to be added as additional insured and provided a waiver of subrogation. So if you have one of your pilots out there, that's what you should do. You should have him added as additional insured. They provide a waiver of subrogation so that when the loss happens, you go right to their policy saying, we're covered, you can't sue us. And they can do that. It's very simple and straightforward. Mm-hmm. For you, yep. For an employee, two things. First off, if he gets sued personally, which he will since he's a pilot. Oh, so he's on board as a passenger? Oh, if he's just on board as a passenger, then it's just a straight liability claim to you. He'll sue you for $5 million on average. Yeah. It's when he's acting as a pilot when you have problems. Other question? Depends on what terms and conditions we're talking about. So most policies are almost infinitely changeable as long as we know what they are and what we're trying to accomplish. Some things aren't. An example is that engine lease agreement. I can tell you right now, if you go ask your insurer to add Rolls-Royce as an additional insurer on their policy, they'll say, fine, I'll add them as additional insurer, but I'll specifically exclude their manufacturer service of that engine. They'll specifically exclude it. They won't cover it. So it really depends on what exposure we're talking about. But more often than not, you can get things changed. Especially when you have that insurer relationship, that's the other important thing. I'll give you an example. One of my clients has been a client for 10 years. I picked him up as a client because he was having problems getting the second in commands approved. Why are you having problems with second in commands getting approved? So I asked him, so what's the deal? He goes, well, I'm 26 years old. I have 2,600 hours this is a Hawker 400 at the time. And I've never met with my insurer. You're 26 years old and you're a chief pilot on a Hawker 400? Yeah. I said, how'd you get 2,600 hours of flight time in a Hawker 400 at age 26? I was a valedictorian for Purdue University and I flew for Purdue a lot of years. Oh, okay, well, that's interesting. So we took over his account, sat down with his underwriter, outlined what he wanted to do with his second in commands. Very next day, the policy was endorsed. Any pilot approved by him is covered as a pilot. So it all depends on the circumstance, and it's really important to have that insurer relationship and to know what you're asking for and what you're outlining. Any other questions? Was insurance fun today? Ready, Al?
Thank you, Scott. I appreciate it very much.